This is Bill Hornbarger, Chief Investment Officer for Benjamin F. Edwards, and we're here today to talk about a topic that's top of everybody's mind, inflation. And inflation measures have increased in calendar year 2021 to levels that a lot of people are uncomfortable with, both policymakers and investors alike. The Federal Reserve, when they talk about inflation, they use the term transitory. And if you think about transitory, when they talk about it, they really mean factor-based, not necessarily time-based. But more recently, some Fed officials have pushed back against the idea that these inflation pressures are transitory. Recently, our Investment Strategy Committee met and took up the topic, and we asked ourselves the question, within the context of strategic asset allocation, a 7 to 10 year outlook, do we think inflation will be persistently higher? And if the answer to that question is yes, should we account for that in our asset allocation models? As you can imagine, opinions were varied. We had a very good debate around it, but a consensus view coalesced around the idea that yes, we think inflation will remain elevated into calendar year 2022, but longer term, we think inflation pressures will recede and inflation will come back to those numbers that are more consistent with longer term time horizons, 2.5%, 3%, 3.5%. That's certainly higher than investors have become accustomed to over the last decade. But again, very consistent if you look at longer time horizons, 25 and 50 years. Our view is very consistent with other measures of inflation expectations. If you think about survey-based measures, the University of Michigan inflation expectation numbers, they look at 1 year and 5 year inflation expectations. 1 year remains elevated, right around 5%, but longer term, 5 years below 3%. And then we can get a market-based idea of inflation expectations from the TIPS market. If we look at 5 year and 10 year inflation break-even rates from the TIPS market, they are both below 3%. So again, our view is very consistent with what we see in other measures of inflation expectations. We also feel that a lot of the disinflationary forces are still in place. If you think about globalization, if you think about technology leading to productivity gains, and even demographics, we think a lot of those trends, longer-term trends, are still in place despite kind of the current disruptions we see related to the pandemic and COVID. A couple of other factors to think about as we move forward that lead us to this view. One is this idea that inflation is transitory, and probably the best anecdote that I can give you about that is used car prices. If you go back to earlier this year, June, used car prices increased 45% on a year-over-year basis. And even more recently, used car prices are still up about 20% on a year-over-year basis. If you think about the factors that lead to that, we have a chip shortage right now, so the production of new cars is down at a time when demand is up. A lot of people, because of the pandemic, moved farther out from larger cities, and we have a lot of people that are returning to work that are afraid to ride public transportation. So you have a decrease in supply, you have an increase in demand, obviously you're going to get higher prices. We don't know when it's going to happen, but we do believe that those factors are going to recede and are transitory, and used car prices will not grow at those 20, 30, 40% year-over-year rates. And it's not to say that used car prices are a huge part of inflation, but when you get 45% increases even in small weights, they do have an impact. I think the other thing to think about is the so-called base effect, and we talked a lot about that this year. We're comparing today's inflated prices to last year's pandemic-depressed, recession-depressed prices. So it would be natural that we'd have larger year-over-year increases. Well, as we work through this year and head into next year, that's actually going to reverse itself. We're going to be comparing next year to this year's inflated prices. So we think how we measure inflation on a year-over-year basis will get some relief from that number. All of this is a long-winded way of saying that we feel like, yes, we are thinking about inflation. Inflation pressures will persist into calendar year 2022, but longer term, these trends that we talked about, we think will still be in place. Inflation will recede back to that 2 to 3% level. From an asset allocation perspective, we think the moves that we made earlier this year leaning into equities, leaning away from bond yields that have negative real yields, yields below the rate of inflation were the right moves to make, and we think they still are the right moves. We'll revisit our asset allocation as we head into early 2022, but we still think this is an environment that will be positive for equities. Yes, we think we'll see some volatility around tapering, around Fed activity, if inflation does stay elevated in 2022, but from a longer term perspective, we still think this is an environment that will be positive for equities and equity valuations.